Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. A $30 billion bid for Santos by the Abu Dhabi National Oil Company sent shares in the Australian oil and gas giant soaring. On the surface, the offer from the consortium, led by ADNOC's investment arm XRG, seems pretty good. But there's plenty of barnacles on this one, including the need for the federal government to approve it. Jim Chalmers recently said there's a long way to go before a deal can be done. So what's it mean for Santos, for investors, the local market, and for the state of the oil and gas industry more broadly? Remember, this is general information only, and you should seek professional advice before making investment decisions. Nik Burns is the head of energy research at Jarden. Nik, welcome to Fear and Greed.
Thank you for having me, Sean. Appreciate it.
First up, was this a surprise that ADNOC, the Abu Dhabi group, bid for Santos?
Look, in a nutshell, yes. Whilst Santos a couple of years ago made its intentions known that it was open to offers that would realise value for shareholders, we subsequently saw an approach by Woodside. They walked away from that transaction pretty quickly. Since then, it's been pretty quiet, and it seemed like Santos was confident enough just to progress through its growth strategy, delivering Barossa LNG and Pikka oil project in Alaska, and try and increase its share price through the startup of those projects by the middle of 2026 and achieving that outcome. So the arrival, if you like, of ADNOC on the scenes was certainly a bit of a surprise to me, and I suspect many in the market as well.
What is it that ADNOC likes about Santos? What are the assets that are the gems?
Yeah, so look, you can broadly break Santos into two groups, their LNG assets and then their non-LNG assets. And if you look on the LNG side, it's really those assets which would be of particular interest to a company like ADNOC. And if you look back in terms of what ADNOC said, they set up XRG as a subsidiary about 6 months ago with a specific goal to grow its international oil, gas, and chemicals operations. And a couple of weeks ago, XRG released its 5-year plan. And in that, it had a very specific goal of growing its international oil and gas footprint, in particular on the LNG side, growing that to 20 to 25 million tonnes per annum capacity by 2035. So within Santos, if you roll the clock forward maybe a year, once Barossa LNG is fully up and running, Santos will be producing around 7 million tonnes per annum. So that certainly would be attractive to ADNOC, as if you scour the world and see what's for sale or which companies or entities might be open to an approach, certainly Santos would have been pretty high on the list.
Santos, and I suppose we better put Woodside into this conversation as well, in terms of global producers of LNG, are they efficient? Are they highly regarded? Where do we stand?
Yeah, it's a good question. I think if you look in the broader market, so the global LNG industry is around about 410 million tonnes per annum. So 7 million tonnes on its own, represents less than 2% market share. But certainly if you look at the quality of the assets within the portfolio, Santos has 3 major LNG exposures. You've got PNG LNG, obviously in the country of PNG. You've got the Gladstone LNG project in Queensland, which has had some supply challenges and it's probably not a top quartile project by any stretch. And then you've got the Barossa LNG project that's due to start up in the next 6 months off the coast of the NT. So within that, certainly PNG LNG would argue is definitely top quartile project. It's very high margin. In the fiscal terms, fairly bit benign as well. Australia's seen as a pretty safe jurisdiction to invest in as well, and it's on the doorstep of Asia where most of the LNG demand's due to grow. Similar to Woodside. Woodside's LNG footprint is very much dominated in Australia to date. Obviously, they're making moves to invest and expand their capacity in the US, but certainly having a large footprint in Australia on the doorstep of Asia is very attractive to a number of companies.
At this point, the price that they're offering, so it's the equivalent of about $8.89, $8.90 a share Aussie. It's trading at about $7.70, $7.75 at the moment. Is it an attractive price? And is the arbitrage or the difference between what's the offer and what it's trading at, just a reflection of the fact that it's a long way to go before this deal's done.
Yeah, look, I think there's a couple of things in there, Sean. First of all, to your point, like there is a long way to go, and everyone's trying to work out exactly how long the process will run from here. We estimate that both there is the key steps ahead is due diligence, and that's likely to kick off shortly, and that could last a couple of months, and that will then lead to the two groups signing a scheme implementation agreement. But ultimately, they can't move ahead to a scheme meeting where Santos shareholders would vote on the scheme, and therefore there's this price until they receive all the relevant regulatory approvals, including FIRB. And it's really, I think people are focusing quite rightly on FIRB approval, and that will take realistically at least 6 months in our view to be done. So you're probably looking at sometime in Q1 2026 before we'll know whether the Australian government is on board with this takeover. So that's probably one element that people are looking at. So there is a time value of money, and then the probability of the government actually signing off and allowing for this takeover to go through.
Stay with me, Nick. We'll be back in a minute. My guest this morning is Nik Burns, Head of Energy Research at Jarden. We've been talking about Santos ahead of the break there. What about the state of the oil and gas industry generally? Certainly gas seems to be the, it's not quite the commodity du jour, but sort of gas wasn't so popular a little while ago. Now everyone realises that it's the transition energy commodity. Do we expect to see more of these sorts of deals going forward? Look,
it's a good question. I think in the Australian context, certainly gas has been through a bit of a roller coaster ride in the last 10 years. It's provided a lot of heat and energy to large industrial companies in Australia and overseas, and it obviously provides a bit of a backstop to companies on the electricity market. So it certainly plays a key role there. But there was a growing concern around global warming and the desire to decarbonise Australia, pushing ahead initially, removing coal from the electricity grid, but gas is sort of thrown in the same conversation. And I think it probably took Russia-Ukraine events and a real large spike in gas prices for the market to realise that the consequence of higher energy costs affects everyone and everything, and including driving higher inflation, which we're still struggling to tame. So through that context, it feels like through an Australian lens, if you like, Australian companies here feel like they've got more of a mandate now to invest in gas. And that's something which I think the federal Labor government has embraced as well. They had the Future Gas Strategy report released last year, which effectively acknowledged what I think most people realise is that gas will need to be around for the foreseeable future, particularly just to back up renewables in the grid. So that certainly provided a positive backdrop for anyone looking to invest in gas in Australia.
What about Woodside? I think I'm right saying that they did a deal with Saudi Aramco, or sort of an agreement with Saudi Aramco to pursue potential JVs together going forward. It just seems that oil and gas industry, I suppose, has always been really global, but those Middle Eastern powers just seem to dominate, such that you've got the Woodsides of the world trying to jump on board almost.
Yeah, look, I mean, if you've been through the Middle East recently, you can see the power of the petrodollar there in terms of what it's done from a transformational perspective to the respective economies of countries like UAE and others. So certainly there's a lot of cash out there, and I think they're realizing that they are the source of their wealth has been from their oil deposits in their own country. And I think they're all taking now a longer term look globally about where they need to invest, because are we going to be driving, petrol cars in 50 years time? And what's the oil outlook looking long term? And they're taking a very long term approach here. So it's not a surprise in some respect that you're seeing Woodside signing deals with the likes of Aramco. It was disclosed in the Tellurian takeover that Woodside did last year to get its whole hands on the Louisiana LNG site, that they were teamed up with Mid-Ocean Energy, which is partly owned by Aramco. So they've certainly been known to each other for some time. And I think as the Middle East countries, with the balance sheet capacity looks to expand globally, you're probably expecting to see more of these types of deals rather than less.
Are these oil and gas companies shifting to renewables? I mean, I know Total, which is a French group, has certainly, if you read the media, is trying to get into renewables more than it ever was before. But are they actually doing that or not?
Look, it's a bit like Australia, certainly European oil and gas companies such as Total, BP, etc. They've been through their own journeys, if you like. They've been under considerable shareholder pressure to pivot and direct more capital into renewables. And some of that's been successful, some have not. You've seen BP recently acknowledging the fact they've probably gone too hard, too quickly into renewables. The returns there don't compete to oil and gas. So they've realised that they need to probably pull back a bit and redirect more capital back into oil and gas. So it's not just an Australian phenomenon, if you like. It's certainly one that we're seeing overseas as well.
Fascinating. Nick, thank you for talking to Fear and Greed.
My pleasure. Thank you very much for having me. Appreciate it.
That was Nik Burns, Head of Energy Research at Jarden. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm Sean Aylmer. Enjoy your day.